Welcome back to the Neuro Finance Masterclass. This is day 91 of our 365 Days to Financial Freedom series, and today we are embarking on a really critical mission. We are cracking the true code of digital sovereignty. Because here's the thing, if you want to protect your capital and build an all-weather portfolio, you just cannot approach crypto the same way you approach traditional stocks. We're throwing out the old playbook today. Instead, we're diving straight into the raw mathematics that actually govern this space. Our theme for today, Tokenomics, the sovereign math of crypto.
Exactly. Our goal with this explainer is to arm you with a deeply protective, elite understanding of where value actually comes from in digital assets. We aren't here to chase hype. We're here to master the numbers. Think about it. If you don't understand the underlying mechanics of what you're buying, you aren't investing. You're just gambling. And in this masterclass, we definitely don't gamble.
So let's take a quick look at our syllabus for today's explainer. We've got 5 modules lined up. First, the price tag illusion. Then, the holy trinity of supply. Module 3 is market cap, the sovereign math, followed by the vesting dilution trap. And finally, we're going to wrap things up with the token audit.
All right, let's dive right into Module 1, the price tag illusion.
You know, this illusion literally bankrupts amateurs every single cycle. We have to completely unwire the way your brain naturally wants to look at numbers on a screen. Unlike traditional finance, crypto assets don't have PE ratios. They don't have physical factories pumping out quarterly revenue reports. Instead, their value is driven entirely by tokenomics, the internal monetary policy and supply mechanics written directly into their smart contracts. As an architect of your own portfolio, you have to evaluate the code, not a corporate balance sheet. And that brings us to this number right here, 1/10 of a single penny. The absolute biggest trap for a beginner is buying a coin simply because it has a tiny price tag like this. It is incredibly tempting to look at this and think, wow, if this just hits $1, I'm going to be a billionaire, right? It's a complete delusion based on a fundamental misunderstanding of how supply works. Today, we're shattering that illusion forever.
Which leads us straight into Module 2, the holy trinity of supply. To properly evaluate any crypto network, your neurofitness requires you to instantly check 3 distinct metrics before you ever even glance at the price tag. The first pillar is circulating supply. Think of this as the tokens that are currently unlocked, liquid, and actively moving around in the public market right now. This is the active supply dictating the current market dynamics day to day. It's basically your baseline for everything.
Then we have the second pillar, total supply. This reveals the number of tokens that have been created in existence so far, minus any tokens that the protocol has permanently destroyed or burned. Now, what's really interesting here is that total supply includes tokens that physically exist, but might not actually be hitting the open market just yet. Keep that in the back of your mind, because it is going to be absolutely critical in a moment.
And finally, we have the third pillar, max supply. This is the absolute hard cap. The ceiling. It's the maximum number of tokens that will ever exist in human history for this specific asset. Once this limit is reached, the code dictates that no more tokens can ever be minted. Period.
And this brilliantly illustrates why max supply matters so much. On one hand, you have a deflationary hard cap. Bitcoin is the pristine example here, right? Its max supply is strictly, mathematically capped at 21 million. Contrast that with so many modern tokens structurally designed to have an infinite maximum supply. If a token has an infinite max supply, it's basically designed to inflate indefinitely, just like the fiat currency you're trying to escape.
All right, Module 3, market cap, the sovereign math. Here is where we bring price and supply together. Look at this formula, and seriously, burn it into your system right now. Market capitalization equals the current price multiplied by the circulating supply. This equation is indisputable. It proves mathematically that the price tag alone is completely irrelevant. The supply matrix is the whole shebang.
Let's look at how this plays out in reality. Remember that beginner who buys a coin at 1/10 of a penny, hoping it hits $1? Well, let's say that coin has a circulating supply of 10 trillion. At its current tiny price, its market cap is $10 billion. Not bad. But for that coin to reach the $1 dream, its market cap would need to hit $10 trillion. To put that into perspective, that is larger than the GDP of entire superpowers. The math simply does not support the dream.
This brings us to Module 4, the vesting dilution trap.
Pay really close attention here, because this is the most dangerous, hidden fundamental danger in the crypto market. When a new project launches, early venture capitalists, the VCs and team members, usually buy their tokens for literal pennies. But to prevent them from dumping immediately, those tokens are initially locked up. However, look at this timeline.
Every month or every quarter, millions of these cheap tokens are systematically unlocked. This creates a massive, continuous wave of scheduled sell pressure just hammering the market.
The contrast is just stark. You have insiders who got in at pennies with virtually zero initial market risk versus retail investors who are blindly buying the coin later. If you buy a token right before a massive unlock event, you are actively buying into delusion. You're walking into a trap, and quite frankly, you're just acting as exit liquidity for those early venture capitalists. Notice that massive segment on this chart representing locked tokens. If you see a token where only 10% of its supply is circulating and 90% is locked up waiting for insiders, run. That tiny circulating supply creates a dangerous illusion of scarcity. It artificially pumps the price up, only to be completely destroyed when that 90% inevitably unlocks and floods the market.
And that leads us to our final section, Module 5, the Token Audit.
We want to empower you with a specific task to execute the literal minute this explainer is over. Here's your 3-step homework. First, pick an altcoin outside of Bitcoin or Ethereum that you currently hold. Second, open a crypto data aggregator like CoinMarketCap or CoinGecko and compare its circulating supply to its fully diluted valuation or FDV. This shows you what the market cap would be if every single token existed today. Third, check the active supply. If it's less than 50%, you need to aggressively research its unlock schedule immediately.
Consider this your rally cry. Stop trading digital tokens like random lottery tickets. You are an architect building an all-weather portfolio. You need to master the math, sidestep the dilution traps, and start auditing these assets like a sovereign central banker. Because the rules of supply and demand are absolute.
So we'll leave you with this final, crucial question to protect your capital. When you buy a digital asset, are you investing to rule the cycle, or are you just providing exit liquidity for insiders? Master the tokenomics, and you will never fall for the price tag illusion again. Thanks for joining us in the masterclass today, and keep auditing those portfolios.